Hi, I'm Steve Van Metre, and welcome to your Monday Night Live that's being pre-recorded. So for those of you who are wondering, my wife is now home. Surgery, huge success, as I mentioned in one of my prior updates. Recovery was about 6 days in the hospital, a ton of pain. So if you're curious, what they did is they put two rods, upper spine, 10 levels, so quite a few. And if you're curious what it looks like, we've got an x-ray before and an x-ray during surgery. Now, the x-ray during surgery is not gruesome, so if you're freaked out about some of that stuff, I totally understand. It's not at all. You can just see her spine and you can see the hardware of what they put in. It's on her Facebook page, which is Kimberly Smith Van Metre. I'm sure she's probably on my Facebook page somewhere. So if you can't find her by name, but you'll find a post and she's got a side-by-side of the before and after. And wow, what a huge difference. So it's going to be a while for her to get fully recovered, but there's no doubt it's going to have a huge quality improvement in her life. So I'm kind of looking at what was going on Sunday night. Fed Chair Jerome Powell came and spoke, spoke to 60 Minutes, but he gave an interview to 60 Minutes, which was extremely unusual. He's the first Fed Chair since former Fed Chair Ben Bernanke to speak to the public in this fashion. And it's, in my opinion, a massive puff piece. Now, if you missed it, it's no big deal. I didn't see it live either. You can go to the 60 Minutes website. It's totally free. It's ad supported, so you don't have to worry about logins or any of that stuff. But it's really this case where the Fed is trying to justify everything they're doing. And as you know, from watching all my updates and reading my stuff, the Fed creates every expansion and every contraction accordingly. And they're really just trying to justify their existence because at this point, we have 10 years of global central bank easing. And the moment they start to stop, the global economy hits a toilet. And I mean, it's just such an absolute mess that they've created. And the problem is they can continue to ease, but all that does is create a huge wealth divide. I mean, bigger than the one now. And it leads to massive currency inflation, which is really bad. So they're in a catch-22. They are trying to support the economy. It's not working. So Fed Chair Powell came out to justify his case, most likely because President Trump is not happy with him. Of course, President Trump also nominated him. So, there you go. But you can only do these easy money policies so long before people find the value of their currency is worthless. And at that point, everyone realizes the piece of paper in their wallet is actually just a piece of paper. And those digits on your computer screen, well, they have no meaning either. They are also just digits. So the Fed is under this big push to continue to establish credibility and faith in the system. And they got to do it any way possible because it did not work. So we don't have, I don't know how much time we have. We'll keep this to about 15 minutes, but I want to show you something that I was kind of curious about monetary lags. And I wrote about it this week, and if I sound disjointed now, wait till you read Friday's update, because it's probably just about as disjointed as this. But I wrote a lot of this stuff in the hospital on not a whole lot of sleep. So I want to show you kind of what I looked at, and then we'll hit the charts for Monday and see what a bizarre reaction in the market today. When you get news in overnight trading from foreign markets about how bad the economy is, you see U.S. stock prices going up. I mean, it's like, what's going on? It's kind of crazy. Anyways, the content of this video is provided as educational information only. It's not intended to provide investment or advice. Materials not to be construed as a recommendation or solicitation by a selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre. My own personal passive business expressed video that I'm going to do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So let me get switched over to the web browser here. And all right, world dollar liquidity. So I was thinking about monetary lags, and for those of you who want to create your own chart of world dollar liquidity, you can go to the St. Louis Federal Reserve website, fred.stlouisfed.org. You can make an account. You don't have to do this. And all you need is to put in the federal debt held by foreign and international investors, which the short code is here. And then you add the line St. Louis adjusted monetary base, short code is there. Set them both to percentage change from a year ago. And then here's the key. Go down to this formula, put A. Here's A plus B, hit apply, and then magically you will get the chart on world dollar liquidity. Now we know, because we talked about it, and the moment it does update, I will share it with you, that the fourth quarter data has not yet been released. I do not know when that will be, and it's the fourth quarter data of the federal debt held by foreign and international investors. So what I was curious about was monetary lags. Now, fortunately, and I don't know if it's an issue with the St. Louis Fed or the Standard & Poor's Company, but they don't have a lot of data on the S&P 500 anymore. They used to. So what we're going to do is we're going to put in the Wilshire 5,000 total market cap index, which is meant to be encompassing 5,000 U.S. stocks. Unfortunately, it only actually has 3,500 because there aren't 5,000 stocks anymore. So anyways, we want to stick that over here on the right side. And what you can see is on a year-over-year basis, for the most part, stocks follow world dollar liquidity. So we see world dollar liquidity rising there. I know that box is going to show up, and there's nothing I can do about it. And then you see stock prices on a year-over-year basis rise, and you can see world dollar liquidity fall, and stocks fall, and rise and fall. And then you have right here, and you can see world dollar liquidity is contracting, which suggests the stock prices should be contracting with it. And I didn't do this when I was in the hospital, but let's just see for fun what happens if we just put the index over there, if it'll even fit. I don't know. Oh, whoops. Wrong one. Yeah, we don't really see it, but you can see how world dollar liquidity was contracting. It should have created a recession here in 2016, and it didn't happen. But nevertheless, what is also interesting is I overlaid 10-year Treasury yields. So let's see if I can close that out and get rid of that. And this I thought was a little more interesting because we know stock prices they do have a function with global trade. So when trade slows down, what happens? Profits slow down and stock prices go down. So here's the 10-year Treasury yield. Let's put it on there. And we'll go and get it on the right side so we can see it a little easier. There we go. And you can see that interest rates really respond to world dollar liquidity. So as demand falls, and we see world dollar liquidity contracting, interest rates, they also go down. So here interest rates are way up here. World dollar liquidity is contracting. And you get the general idea that, I mean, even here, when people think the year-over-year rate of interest rates is rising and the world dollar liquidity contracts, like, boom, nope, interest rates go down. So you can see even going into the 2002 recession, the dot-com bubble, that people were wrong about interest rates there. And here, again, they were wrong going into the mortgage crisis because they fell on a year-over-year basis. But let's go in here and see if we can just switch this to regular mode. I don't know why. This is so laggy all of a sudden. There it goes. Come on. I have pretty much everything shut off, so I don't know why it would be doing this, but let's, here we go. All right, we'll close that. That's not what I wanted. All right, let's try this. Cleaning. Come on. Boy, this browser window is toast. Let's go try that again. There we go. So the answer is the Federal Reserve website is down. And all right, well, so much for that. We'll try that again in the future. But when you overlay interest rates on there on the year-over-year change, you can really see that interest rates do fall when world dollar liquidity collapses, and that would have been interesting to look at. But well, there you go when you do things live. All right, so we've got about 6 minutes left. Let's jump into the charts. The S&P 500. Gapped up this morning on bad international data, crossed its 200-day moving average, which will bring program trades in. Now, why would I say that? Well, there are computerized programs that look at the 200-day moving average. So when it crosses above, they'll buy. When it crosses below, they sell. So they sold Friday, and now we're going to buy back today. So they may have sold Thursday. It was pretty close. But anyways, I would bought back today. This was a lot of this move was corporate share buybacks. And here's the resistance zone. And why is this issue with corporate share buybacks important? Well, it's simple. We are a little over a week away from a monster blackout period again. And so you got to get your last of your buybacks in. Remember, we have seen buybacks running at a rate of about double what they normally did last year, which is pretty incredible. Let's go on and see what happened with the volatility index. It crossed below support, although there's been buyers down in here. And so from what I heard today from traders, they said there's a lot of call options bought on the VIX today, suggesting that people believe volatility is headed higher. 10-year Treasury yields, big non-confirmation of stock prices. Now, if this move here in the S&P was valid, then what we should expect to see is yields way up. I mean, they should have literally just gone straight up, like, the opposite of this, maybe like these green lines. It should have gone just straight up back to about 2.7, 25 or somewhere in there, and they didn't move. They really just did not move all day. I mean, they went up, but they traded except slightly down, but effectively flat. Even 30-year yields, they traded up slightly, managed to close right below their 50-day moving average. And 5-year Treasury yields, they went up and tagged what was support, which has now become resistance. And they're looking like they're headed lower. So again, it's kind of interesting that today's move in the market was not validated by Treasury yields, and nor was it validated by volume. I mean, you have this big move in about the same volume, mediocre volume we've seen in the past. Now, if it was validated by a big chunk of volume like this, well, that gets more interesting, but it wasn't. So this is, again, has corporate share buybacks written all over this thing. All right, so let's go and look at gold. There we go. And what was interesting about gold, it crossed below its support line, came back up, tagged the top of support, which has now become resistance. And then today, it just couldn't get past 1,300, and it kind of just immediately sold down, which tells us it's headed down here to this 1250, 1240 range. Now, what I want to do is add volatility to this real quick. And we'll overlay it. Now, volatility, you can see they track, and I wish I could make this purple line darker or bolder or different color, but I can't, so I'll just keep my mouse over for a moment. But what you can see is there is a relationship here. Now, it's not exact. So volatility went up here, but gold did not get up here. And we could argue that it's lagged perhaps by, maybe 2 months. I mean, that would not be unrealistic, but what it tells us, well, in fact, actually, if I could move this over, that actually does look pretty good, because then this little bit right here, it looks like it's showing right here. But what it tells us is that gold should come down right into this range, somewhere around 1,200 or this 1240 to 1250 range, and we would be fine with that for a buy-in point, because that's confirming that these are all real buyers down here that are holding gold prices up. So that would be a very reasonable thing to expect. And because of volatility, we don't want to buy gold until it's come back down. And this chart pattern here of it hitting resistance and failing tells us it is headed lower. We just don't know where lower, here or down here, are its next major moves. Let's take a look at the 7 to 10 year Treasury bonds. They are still sitting here waiting to break out higher. The long bond, the 20 plus Treasury ETF, it held its 50-day moving average, so it crossed its 50-day on Friday. Well, it looks like it on Thursday. Really made a point of it on Friday, and then came down today, tagged the 50-day, and managed to hold itself there. So again, that remains a very bullish signal for the Treasury market. All right, so we've got about a minute left. Let's see. Let's take a look at oil and gas producer stocks. Here again, they crossed through what was support. They came up over the support channel here, broke down, trying to see if they can get back up there. They didn't do that today, but again, here's another indication. If stock prices are valid, and we go on here and add the S&P 500, well, you can see they're detached from reality. So either oil and gas producing stocks need to be way up here, which would be a pretty giant move for them, or the S&P 500 should be trading down, say, around 2,500, which seems more logical due to their recent and very close relationship. You can see, I mean, every time the S&P has gotten a little out of line, boom, 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 down it goes. Again, it's all this is telling us is there is a retest of the December lows coming, and if not for the S&P 500, although I believe it will, oil and gas producing stocks are, and that's because they are failing to get back into their support zone again. So when you break through support, it becomes resistance, and that gets to be very interesting. So we're about the 15-minute mark, and we're going to wrap this up. We'll be back Wednesday. I was going to do this today, but I wanted to look at that world liquidity chart, and well, you know, the internet will be the internet sometimes. But we've got the backlog of the hedge fund data, or the large traders that the government keeps track of. That during the blackout, they didn't have the data. They're finally caught up. And I kind of wanted to look at that, but maybe we'll do that on Wednesday. So I'm Steve Van Metre. Till Wednesday, I'll see you.